I am Brandon Snow with Cambridge Global Asset Management. I'm a portfolio manager and co-CIO focusing on North American equities. It's been a very interesting year so far this year on both sides of the border. In the US, you've seen a very bifurcated market where interest-sensitive companies in the telecommunication, REIT, and utility space have had significant performance, while a lot of the higher risk areas of the market, including growth companies and more cyclically exposed companies, have seen the stock prices fall. In Canada, it's actually been interesting for a different reason. A lot of the areas that had difficult years last year, including the commodity space across the board, specifically gold equities and into the energy side as well, have seen a nice rebound this year. When we look across the board there, we feel that the one area that fundamentals have improved is the natural gas equities. We're coming off one of the coldest winters in 80 years, actually, in North America, and that's left us with storage levels at the lowest levels they've been since 2003, 2004. And we think that dynamic, that supply-demand dynamic, actually offers very nice support for natural gas pricing over the next 12 to 18 months. Cambridge, we're really focused on absolute returns at the end of the day, and then that means we put money to work in where we find opportunities where the risk is actually compensated for by the return potential we have in those ideas. Combination of an equity market that's fairly valued today, fundamentals flat to deteriorating in some cases, has us at higher cash levels than we have been historically. Our cash levels across our Canadian-focused funds are in the 20 to 25% range, and really what that means is the non-core part of our portfolios, we're not finding the opportunities that we've liked historically. The core names that provide the bedrock returns for our portfolios remain. Those are the type of companies that we believe create value for shareholders over a significant amount of time, so that's really unchanged in most cases. It's the non-core side of the portfolio where we're taking our time to find the best risk-reward opportunities that we can get. So patience, I think, will definitely be a virtue right now. Again, from an absolute return perspective and the potential returns you can get in a fairly valued market, we still think equities are a pretty good place to be. On the non-core side of the portfolio, we will remain patient to get that cash to work. It's a very interesting situation when you look at equities, and I'll comment their fair value, but if you look at them relative to the entire fixed income space, I think they're significantly undervalued. Fixed income has had a real rally this year from the government bond space all the way through the high yield space. And the way that I would phrase it from an absolute return perspective is today you have to buy junk bonds to get the same return that 7 years ago you could get risk-free. So junk bonds today yield you about 5%. 7 years ago, you could get that in government paper, and we don't believe the risks across many fixed income instruments actually are justified by the return potential that they can generate today.